and welcome. My name is Jeremy. I am a tax consultant with SFI Kenya. SFI Kenya is part of SFI Global, one of the top 20 accounting networks globally, and with presence in over 100 countries and over 14,000 staff members. And today we want to look at tax consulting or tax compliance for consultants. And one of the things to just get right off the bat is the fact that consultants, the moment that you're considered a consultant, then the taxman considers that what you have is business income. In terms of the categories of income which the taxman taxes, you have business income, you have employment income, you have interest income, and rent income, which are known as the specified sources. So the moment you are considered a consultant, then your income is considered to be business income, which brings us to this good categorization here of the main taxes that businesses or small businesses in particular face in Kenya. And I say the main two taxes because there are different taxes depending on which industry you're in, but particularly if you're a small business, if you're a consultant, then you're most likely to fall under or to incur these two main taxes. So the first tax is income tax, and income tax is further categorized into 1, income tax for individuals, and 2, income tax for corporates. And for individuals, we say that this is taxed on a graduated scale. And that means that the first 24,000 in a month, or if we are looking at a consultant, then you're probably thinking for the year, that is the first 288,000 a year would be taxed at 10%, then the next 100,000 at 25%, and then 30%, and so on. So that is what is known as the graduated scale. And then for corporates, these will be companies. This is taxed at a flat rate of 30%. So that is the first tax which will affect you as a consultant. And the second tax is VAT. That is the value added tax. And this only applies if you are making over 5 million per annum, which might be a modest sum, because then you're talking of just slightly less than 500,000 per month. So if your revenues as a consultant are exceeding 5 million per annum, then you are required to register for VAT. Now, one of the misnomer or one of the misconceptions which we have observed is that there are many consultants that will assume that because they are an individual and their incomes, that is the consulting income, in this case considered business income, has exceeded 5 million. They assume that because I am an individual consultant, then I am not required to register for VAT. Then that will be erroneous. It is not just because you are a company. The issue is your business income. In other words, paraphrased, what determines whether or not you register for VAT is not the form of business registration. It is whether you have reached the threshold, and the threshold in this case for registration is 5 million per annum. And I want to assume there that that as a consultant, then you would be able to know how VAT operates, and that the VAT payable would be VAT on sales less VAT on purchases. So one of the most important things for you as a consultant is to be able to track your expenses. Why is this important? One is because if we just think through the two categories which we spoke about, the two categories of incomes. One is income tax. So income tax for you as a consultant, you see, as a consultant, you're being considered as a business, which essentially means it is business income. And that business income is taxed on the profit. So profit means it is your sales less your expenses. So what happens if you fail to track your expenses? Then it implies that you're going to have to report a higher profit than you should. And by so doing, you end up paying more tax than what you should. For example, if you report a profit of $1 million instead of $500,000, then it goes without saying that since that is the tax base on which the tax rate is applied, then you end up paying more tax than you should. So one of the most important things for you to be able to do as a consultant, if you want to be able to save on your taxes, is to track your expenses. And there are many ways in which you can track your expenses. We say that you can be able to automate. Now we have quite a number of applications that enable you to be able to even track your expenses on the go. The second reason, if you think now of the second tax, which is VAT, again, the VAT payable, which is payable per month, is VAT on sales, or what is known as VAT output, less VAT on purchases, also known as VAT input. So again, if you fail to track your expenses, if you're not obtaining receipts, and in this case, we'll be looking at that shortly, the eTeams receipts, then it implies that again, you end up paying more VAT than you should. So be able to track your expenses. So previously, the only thing that you needed to do was for you to just have a receipt. And it didn't matter much, especially for income tax purposes. It wasn't very specific. For VAT, it has always been quite defined. But we know now that we have this new sheriff in town in the name of eTeams. So what this means is that for you as a consultant, if you want to be able to claim or to offset, you see, we said here, if I may just go back to this slide, that your profit is sales less expenses. So the essence of eTeams, and there are two ways you can look at it. One is that you are required to have your sales on eTeams. But I think for the purposes of this session, we should not be so much concerned about this as we would be about this. And why so? Because, well, you still want to be compliant and issue eTeams receipts as a consultant, but you should even be more concerned about obtaining eTeams compliant receipts from your vendors, your suppliers. Any expense that you are incurring, you want it to be an eTeams generated receipt. And for the purposes of compliance, some will call it eTeams invoice, others eTeams receipt. The eTeams simply stands for Electronic Tax Invoice Management System. So as long as whoever is selling to you has issued you what is known as an eTeams receipt or an eTeams invoice, then it is one and the same. Of course, we know that some of the features of an eTeams receipt is that it has a QR code, which you can be able to scan and determine that indeed it is a genuine document. Good news is that there are a number of ways in which you can be able to obtain or to either. So if you're issuing, you can be able to issue the receipts through a number of ways, but it also implies that even for your suppliers, then they will also be able to do the same. So one, you can do this through eCitizen. Personally, I find this is one of the easiest ways to be able to raise an eTeams receipt when it is required of you. So you can do it through eCitizen, you can do it through USSD, that's *222#. There's a mobile app. There's the online portal, which is quite common now for companies, and the pay points, which will be, for example, common in outlets such as stores, that is including restaurants and so on. So what we are saying is thinking through you not having to pay more tax than what you should, which is known as tax avoidance, not tax evasion. So then you will want to be able to track your expenses, and these expenses that you're tracking, you want them to be ETIMS compliant expenses. Now, there are a number of ways in which you can be able to save on tax. Number one is on capital allowances. So let's say that for you to be able to provide as a consultant, maybe for you to be able to provide that service, you invest in some equipment, maybe say a laptop, or it could be, even a motor vehicle to be able to take you from one place to another. Furniture, for example, if you set up an office, then what we're saying is that you're able to claim what is known as capital allowance on that. And the capital allowance for what I just mentioned, that is furniture, equipment, motor vehicle, will be what is known as wear and tear allowance. I have it there as depreciation because people at times tend to use the terms interchangeably. You know, that is, you call capital allowance depreciation. Strictly speaking, though, they are different because capital allowance is what the taxman allows you to be able to offset in recognition of the loss of value of the asset over a period of time. So you can see the concept is the same as depreciation because it's still the same. Depreciation is the expense that you're charging to your profit and loss account to recognize the loss of value of the asset's useful life. So why capital allowances and why the taxman will want to determine those rates is because if each and every one of us was using different depreciation rates, you know, for me, I think my computer can only last for 5 years, so I'm going to use 20%. You say, no, I think mine will last for 10 years, so you use 10%. Then there is no harmony and there is no fairness in being able to charge that expense to the profit and loss, which is why the taxman then dictates, or the law, to be precise, dictates the rates to be used. The other things that you may want to consider is reliefs. There are quite a number of reliefs that you can be able to enjoy. As in particular, as an individual, you'll find we have personal relief, and we'll see that when we are calculating, when we have a simulation. Then if there is an amnesty, I think this is relevant for the next 2 weeks, for example, here in Kenya. After that, then we don't know whether there will be another one. You would want to be able to utilize that amnesty. It can save you in terms of relief of or waiver of penalties and interest. Then you find other things will be like meals. Right now, up to 4,000 per person per month. If you are providing meals to staff, then they are allowable. You have per DMs. There are allowances, or there is a relief on that. Then there is for persons living with disabilities and for pension contributions. All those are areas in which you can be able to save and reduce your tax as a consultant. One of the things which is important is something we call PIN checker. And this is a function which is available on KRA's iTax portal, where you can be able to key in your PIN and obtain or get to know the obligations. And so this is not the liabilities, it is the obligations. Obligations means which are the taxes that you are expected to file every other time. So for example, the default obligation most times will be income tax. But then in other times, you will find that you have other obligations, such as VAT and pay as you earn. And the problem is that if you have those obligations on your PIN and you're unaware, then every month you're incurring penalties. and you might find yourself with a huge tax bill, which will have been avoided if you just knew which are the obligations which are on your PIN. So what if you didn't add the obligations yourself? We have seen instances where, for example, sad to say, some parastatals and insurance companies in particular have been the cause for this, where you supply them, and because they are generally, many of them, actually I think most, if not all, are agents, what we call withholding VAT agents. So you as the consultant, you probably, they gave you a gig where you did some work for them and charged them, let's say 150,000, and you send them the invoice for 150,000, and you don't mention anything about VAT because you're not VAT registered, and therefore you're not charging them VAT. But then you find I don't know whether to say an overzealous accountant on the other side who decides to withhold 2% as withholding VAT and file the same. And there have been instances where immediately they do that, then the taxman says, well, if there is withholding VAT, it means you charged VAT, and that triggers a VAT obligation. Although what we've seen of late is that the registration of VAT as an obligation is quite they've made it an onerous task, because we had many people going to KRA and saying, you know, I have this obligation and it was never my intention to have it. I registered at a cyber cafe. So the taxman says, well, to avoid that, you bring all these documents so that by the time 5 years later, we are hitting you with a bill of 1 million and you're refusing to pay, then we can say, no, you wouldn't have brought all these documents if you were not intent on registering for VAT. But the tip there, or the tidbit, is that be sure to check your PIN checker, or to check your PIN on PIN checker, so that you're not having to pay or to accumulate unnecessary penalties. Then on to some tax savings tips. I think we just mentioned about record keeping. Then it's advisable to pay yourself a salary. It used to be previously that this saved you about 7,000 shillings per month, but now I think the figure is much lower. But you still find, for fiscal discipline and to also reduce, you know, arguments with the taxman, like on what's your subsist, you know, how do you subsist, how do you live without, if you don't pay yourself a salary, so that you are capping that, and it's probably we'll be looking at in a subsequent session. This is still mostly likely, depending on the amount, of course, but generally even cheaper than paying yourself dividends. Then I mentioned about capital allowances. Then I just want to mention two things here. One is the value of relationships. And let's look at e-teams. You see, for example, the moment that you issue an e-teams receipt or an e-teams invoice, then the taxman recognizes or acknowledges that you have made that sale. So for example, today is the 13th, and let's say that I issue an e-teams invoice with VAT, then the taxman expects by that 20th July, I'm going to be remitting the VAT that goes with that invoice. So where does the value of relationships come in? To be able to discuss with your client and agree before I issue these e-teams, you know, and it could be the client, it could be the accountant on that side, well, still the client, just in an agency role, to be able to say, well, you know, I'm ready to issue the e-teams, or they say, we are ready to pay you, you then issue the e-teams to us. So, I mean, that is a soft skill, if you think about it that way. And I think you can think of that in terms of skills which are good for us as consultants, beyond the beyond the traditional or the technical skill that we are providing to our clients. I like, and I've mentioned in a number of my trainings, this case, this was the case of minimum tax, which had been introduced in a previous finance bill. In fact, it passed as a Finance Act, and it was going to be a punitive tax, in my opinion, because it was 3% of revenues, which for industries with low margins, such as manufacturing and retail, then this was going to hit them hard. Now, of course, they went to court, and gladly they obtained a victory. But my takeaway is that who is it that went to court? It was not an individual taxpayer, but it was actually a conglomeration. It was parties coming together. We had Kenya Association of Manufacturers, we had Retail Trade Association of Kenya. In fact, we had as well a Senior Bus Association. ISPAC was part of the process at some point. So the point is that you want to be thinking, you know, what is the industry aiming, and how can we be able to lobby? We saw, for example, the doctors coming together and opposing e-teams. Of course, I think that case is still yet to be determined to date. But you see, what we're saying is that there is power in thinking corporate, in thinking synergy, and it's one of the things that you still want to be able to do as a consultant, be able to find who can I align myself with, so that we are being able to lobby together. I want to mention something about withholding tax, and if you're a consultant, then the applicable tax rate is 5%. And what happens is that throughout the year, you will find that as your clients pay you, if the amounts for your invoices or the amounts that are payable within a month are above 24,000, then you end up paying, or you're required to pay, or they deduct. I think that's the most accurate way to put it, is that they deduct 5%. So for example, you invoice 100,000, they deduct 5% and pay you 95,000. Now, what do you do with that withholding tax certificate? I think what you want to know is that 5% is not a final tax. And in fact, maybe I should just mention, even though that was not the focus of this webinar, that even for insurance agents, that the withholding tax so deducted is still not a final tax. What you're expected to do is that at the end of the year, you're required to be able to calculate and say, well, these are all the incomes which I earned. This is the tax on them, having offset the expenses, and therefore this is the balance of tax to be able to pay. And then based on the tax payable, you are able to say, well, but of the tax payable, this amount was already deducted in the form of withholding tax certificates, and this is what remains to be paid. And I think what I'll be able to do is I can just have a simulation here in Excel. Okay, so we have a number of scenarios here. So the first scenario is you as an individual consultant, and assuming that you have incomes of 250,000 per month, all right? And of course, this is an assumption. Ordinarily, the amount will vary. And if you have an income of 250,000 per month, then given it's over 24,000, then your client will be withholding 5%, which is 12,500, which means that in a year, you will make 3 million, being 250,000 times 12. And let's assume, for the purposes of our simulation or example, that you have expenses amounting to 55%. Remember, and that's why we have this comment here, that this 55% is not an arbitrary, it should not be an arbitrary amount. It should be the receipts that we talked about, and those receipts will be, in fact, what the Income Tax Act stipulates is that it should be the expenses which are incurred in generating that income. So you're saying that to generate the income of 3 million, I incurred transport, I probably did a bit of marketing. For example, you probably met up with a client at a restaurant to try and close the deal. You probably outsourced, it could be that a portion of it required specialized skill and you had to use a different consultant. It could be that you have subscriptions, probably to membership clubs. For example, for us as accountants, that will be ISPAC. It could be subscriptions to online platforms. I think we have numerous of those today. It could be communication, telephone, internet, all that, printing, stationery. You probably work out of a co-working space, and as mentioned earlier also, capital allowances. So assuming all those add up to 1650, that is a 55% of just a ballpark figure. But then remember that what you will be doing in your tax filing, you wouldn't be assuming a percentage. You would be listing this, and which again underlines the importance of being able to track your expenses. So assuming your incomes for the year are 3 million, and therefore your expenses are 1650 based on this assumption, then your profit is 1350. And how will we calculate your tax as an individual? If you're operating as an individual consultant, then we would say the first 288,000 is taxed at 10%, which, if you notice, this 28,800 is the same one that is granted as a personal relief, and which is why you'll hear many times people saying that the amount below 24,000 per month, or below, in this case, 288,000 per annum, that's 24 times 12, is not taxed. So why it's not taxed is because it's taxed at 10%, and then you're granted a relief up to 28,800. So you see, this is why we call this a graduated scale, that the first 288,000 at 10%, the next at 25%, and anything above that, up to 6 million in a year, or 500,000 per month, is taxed at 30%. And of course, we now have higher rates such as 32.5 and 35. But those are for those quite high amounts. So let's just work with this. If you're talking of 3 million per annum, then up to 3 million, that's between 388 and 3 million, is taxed at 30%. And then that becomes the tax that is taxed there, less the personal relief. This would be the tax liability. But then how withholding tax certificates come into play is that you're saying that throughout the year, there were certificates being withheld. You will notice that this 150 it's 5% of the incomes, but more importantly, it is still 12,500 times 12. You know that whatever was being withheld each month. And remember here we assumed a constant rate, which is not usually not the case, but for the purposes of demonstration, you're saying that all the certificates you got in the year adding up to 150,000, then you would say the tax payable is 313, but 150 has already been deducted, so we end up paying 163. Now, that is the first simulation for you as an individual consultant, assuming 55% expenses. Now, let's assume that you went further on and you actually were able to track more of your expenses or all of your expenses. let's assume that here, when you obtained only up to 55%, there are some expenses that you missed, and that in the subsequent year, you were more diligent and actually realized that the correct figure for expenses is, say, 2.2. Then now your profit is 750. We subject the 750 to the same process, and we find that there's a tax to pay of 133. But then 150 has already been paid in the course of the year, and you find that there is no balance of tax, or it is you actually end up finding that you have actually a tax credit, or you have overpaid. Of course, this should be refundable, but I'm not sure whether, I'm yet to come across someone who's gotten a refund for this. I know there are refunds in other capital intensive industries like manufacturing, but the point is that by being able to track your expenses more diligently, then the tax you pay definitely comes down. And finally, let's look at the same simulation, but now considered for a company, where you would say that instead of doing the consultancy, say as Jeremy, I decide to do it as Jeremy and Associates Limited. So if that is the case, then what happens is that assuming the same assumption as we had here, that 250 per month, which is 3 million in a year, assuming 55% expenses, same withholding tax rate of 5%. The difference comes here now that you see as an individual, your tax is taxed, or your income is taxed on a graduated scale, but as a company, it is taxed at a flat rate. So a flat rate of 30%, which comes to 405. There is no personal relief because you're not an individual. Then less withholding tax, so you end up with a tax bill of 255, which you will want to compare against 163, 600, and you will find that then the company ends up paying slightly more. One of the ways, again, to get around this has been by paying yourself a salary, because that salary then would be part of your expenses here. It would be taxed on you as the shareholder, as an employee of the company on a graduated scale, but it would provide you a flat rate savings of 30%. But with the increased payroll taxes, payroll obligations, especially subsequent to Finance Act of 2023, in terms of affordable housing levy and enhanced rates for NSSF, then you really want to check out that very, very keenly before going down that route. You may find that there isn't much of a saving under the current tax regime. Finally, just like we did here, looking at if, as a company, you had 55% as your expenses. Now this is you providing consulting services as a company, and your tax finally is 405, 150 has already been deducted, so you end up paying 255. But if you are able to track your expenses again, you find that what you end up paying at the end of the day is 75,000 as opposed to 255. And that, again, just emphasizes the need to be able to track your expenditure. Thank you for listening, and talk to you soon.